Super exciting! We're going to talk about fixed, variable, and adjustable mortgages and how your monthly payment is affected based on the type of product you buy. So first of all, P&I, principal and interest. This is what equates to what your monthly payment is. Let's say your monthly mortgage is $2,000 a month. Usually, right now, interest rates are sitting at about 3.5%. So ballpark, 50-50, your principal and interest will equate to 50% principal and 50% interest. So 1,000 of that is principal and 1,000 of that is interest, based on rough figures using 3%. What happens in a fixed mortgage? Principal and interest payments are locked for the term that you have. Most people usually get a 5-year term. That's a 5. Yeah, that's a 5. 5-year fixed term. And that payment will never change. You can increase it if you want to, but the principal and interest will always equate for the next 5 years the exact same amount and will never fluctuate. What happens in a variable mortgage? The principal and interest payments are set. What that means is they're actually set and locked to the exact same payment that you had from the day that you purchased the property. And let's say that payment was $2,000 a month. What happens though, like when the Bank of Canada sets an announcement that they increase the variable interest rate, like we heard a couple days ago. Let's say your interest rate went from 3 to 3.25 because you're on a variable mortgage. If you have a variable product and the payment is set at $2,000 a month, what's going to happen is your principal payment is going to shrink and your interest payment is going to increase. You're going to be paying more to interest than you are to the principal. If you do not increase your monthly payment on a variable mortgage, what happens? You're paying less principal, less equity down on your house, which means your amortization of your mortgage will go up. If you have a 25-year mortgage, your interest increases, the amortization will go higher, 26, 27, 30 years, etc. So it's very important to adjust your mortgage payment to pay down more principal if you have a variable. What happens in an adjustable? These two are exactly the same options, an adjustable mortgage and a variable mortgage, with the exception of one situation. The adjustable mortgage adjusts the principal and the interest payment for you depending on when the rate increases. So in essence, some banks will call it a variable mortgage, but it's actually an adjustable because they are adjusting your interest payment to reflect the same principal payment to make sure you pay down your mortgage properly so that the amortization continues to decrease at the right figure. So what do we take from this? Fixed, you can trust and you can rely on as the best case scenario to make sure you know what your payments are for the next few years during your term. A variable mortgage might be strategic for rental and investment properties where you just want to set monthly payment and you want to take the net equity out of that investment that you're renting out each month. Highly discourage it though, because with that variable payment, if your amortization goes up, you will not be paying down the equity on your house. So make sure to adjust the monthly payment accordingly if your rates go up. Adjustable is the next best case scenario from a variable because that will adjust your monthly payments and keep you in the safe zone.